We at Coin Rodar have just come to the realization that our humble little show where we take a look at new altcoins, inspect what's interesting about them, and analyze from a casual investor's perspective has aired its 20th episode. So for our 21st episode, we'd like to do a mega jumbo dual-quadruple token episode. Welcome to Coin Rodar Extra Large. Let's begin. First token we have for the week is KAS. Kaspa is a layer 1 blockchain using a proof-of-work mechanism and the Phantom Ghost DAG protocol, which allows for high block rates and low transaction confirmation times. Kaspa's unique features offer scalability, speed, and security, standing out among the layer 1 blockchains. Kaspa launched on November 7, 2021 with no pre-miner allocated coins, which is a feature I appreciate. It shows a level of fairness and transparency that is sometimes lacking in the crypto world. Despite its current remarkable price growth, investors should be aware of liquidity risks. Unlike Ethereum or Solana, Kaspa does not support decentralized apps, focusing on being a scalable and secure cryptocurrency. However, it's led by a strong development team with its founder Dr. Jonathan Sampolitsky, the inventor of the Ghost DAG protocol. So crunching down on numbers, its market capitalization stands at $2.8 billion, accompanied by a circulating supply of 21.5 billion tokens. The token is capped at 28.7 billion, leaving approximately 7 billion yet to be unlocked. Ranking at 27th in terms of market capitalization, it has secured a position in the top 50 coins, marking a significant milestone for the project. Given the undervalued state of the current overall crypto market capitalization, there appears to be promising potential for future growth. Notably, the project has amassed a substantial total of 250,024 holders, indicating strong investor traction and support. But on to the real question, is it even worth bagging? Kaspa represents a notable advancement in the blockchain sector with its unique combination of proof of work and the Phantom Ghost DAG protocol. This blend enables it to maintain a high level of scalability, speed, and security. So simplicity plus high impact equals abroad. Second token for the week is Radiant. Radiant Capital is a decentralized finance protocol enabling cross-chain asset borrowing and earning interest. Users lock Radiant liquidity to enable lending and borrowing, incentivized through dynamic liquidity provision. Radiant operates on the Arbitrum and BNB chain networks and has plans for expansion. The protocol has passed rigorous security audits and boasts over $400 million in total value locked, or TVL. In terms of token utility, Radiant incentivizes users to provide utility as dynamic liquidity providers. Users lock DLP tokens to activate Radiant emissions on their deposits or borrows and share in platform fees captured in blue-chip assets. Presently, the project boasts a market cap of $101 million, indicating that it may still be undervalued at its current stage. With a circulating supply of 366 million Radiant and a maximum supply of 1 billion, there are additional tokens yet to be unlocked, suggesting potential changes of price valuation in the future. The Ethereum network hosts a total of 343 holders for the project, and this number is steadily increasing. Notably, the token distribution among top holders is equitable. But most importantly, is it worth bagging? Overall, Radiant Capital looks to be a strong, secure, and efficient DeFi protocol, facilitating cross-chain asset borrowing and earning interest. Its operations on the Arbitrum and BNB chain networks, combined with planned expansions, exemplify its broad reach within the DeFi landscape. If you are a yield farmer and want to maximize the usage of decentralized applications, then Radiant Capital is for you. Abroad. Third token for the week is BIGTIME. BIGTIME is a multiplayer action RPG for PC that melds a fast combat system with an open game economy where players have an active role in generating and exchanging game items. Their approach is to make Web3 elements invisible to players so they don't represent an obstacle to entertainment and cater to a broader audience. With a funding round of $21 million to bring non-fungible tokens to the biggest game economies, the team wants AAA game companies to adopt cryptocurrency and NFT technology. But to prove that their model works, they are first building their own action role-playing game that will enable players to acquire, hold, and trade NFT-based virtual items without the barriers present in most blockchain applications. The current market capitalization is a modest $45 million, indicating that this token with a total supply of 5 billion is still undervalued. Approximately 201 million tokens are currently in circulation, and the token boasts 7,169 holders at present, and this number is still on the rise. Importantly, the distribution of the token supply among top wallet holders is deemed fair. But as always, is it even worth bagging? BIGTIME is a test for AAA title game companies to introduce blockchain into their game. BIGTIME's idea of using NFT in a game is unique and different from any other game. Henceforth, this is worth bagging. Travala is a travel site that enables its customers to grow the platform and earn incentives through the native token AVA. At the same time, the platform offers booking assistance for more than 500,000 properties worldwide. Travala's platform features a hassle-free user experience. After creating a Travala account, new users can earn a bonus by registering to use AVA tokens. Bookings may be completed using either crypto payments, AVA tokens, or fiat currency. In terms of their roadmap, Travala has come a long way since it was first dreamed up as a concept in 2017. Its co-founders spent many months developing it before it was officially launched in 2018. The initial launch brought approximately $2.6 million in funding, a sizable amount that enabled the co-founders to expand the platform to serve more than 200 countries. So crunching down the numbers, present market capitalization is a modest $27 million, indicating that it is still undervalued with a circulating supply of 51 million and a maximum supply capped at 100 million. So there appears to be more room for potential growth. As of now, there are 599 holders. Another notable consideration is that Binance holds 42% of the supply, posing a potential risk for market manipulation and warranting careful observation. But on to the important question, is it even worth bagging? While some tokens are largely used for trading purposes alone, AVA has bona fide functionality on Travala's DeFi platform. Travala is a major travel industry player that has progressively expanded its offerings and reach since its inception, and it continues to grow today. With this in mind, it's reasonable to expect that AVA tokens will continue to be widely used going forward. And so that is not a prod for me. Fifth token we have for the week is Celestia. Celestia or TIA is the first modular blockchain network that enables anyone to easily deploy their own blockchain with minimal overhead. Celestia stands out by redefining the very core of blockchain networks. Unlike traditional platforms, Celestia introduces a revolutionized separation between transaction consensus and execution. In a monumental achievement, Celestia Labs secured a colossal $55 million in a funding round in October 2022. The backing of industry giants like Bain Capital, Crypto, and Polychain Capital demonstrates not only the financial strength but also the industry-wide recognition of Celestia's potential and prospects. Regarding its token utility, number 1, Celestia-based rollups will use TIA as a gas token and currency. Number 2, being a proof of stake chain, Celestia will use TIA for staking. And number 3, TIA stakers will be able to participate in the decentralized governance of Celestia. Crunching down the numbers, current market capitalization stands at $888 million with a circulating supply of 141 million TIA and a total supply of 1 billion. Notably, TIA is not a capped token, indicating an unlimited supply. The all-time low was recorded at $2.03 and it is presently valued at $6. Despite the recent launch of its mainnet, TIA has already facilitated an impressive 515,230 transactions. And for the moment you've been waiting for, is it worth bagging? Celestia data indicates a strong market presence for TIA, with substantial growth in both short-term and monthly timeframes. The token's performance reflects a growing interest and confidence in the Celestia platform and its potential to revolutionize the blockchain space. Without a doubt, abroad. Sixth token we have for the week is Pyth. Pyth Network is a decentralized Oracle protocol that aggregates and publishes high-quality financial market data on blockchains to make it reliably accessible for on-chain applications. Pyth brings first-party data from financial institutions on-chain. It aggregates this data in a manipulation-resistant way to produce robust real-time price feeds. The openness of blockchains allows anyone to leverage its financial data. This moves us toward the vision of an open, transparent, and fair financial system. In terms of roadmap, they have a significant in-place like multi-chain expansion, governance decentralization, and new data types. So crunching down the numbers, currently it boasts a market capitalization of $750 million coupled with a substantial $200 million in trading volume over the last 24 hours. So it's significantly noteworthy. Pyth has a maximum supply of 10 billion with 1.5 billion currently in circulation. This suggests that the long-term price valuation remains subject to change. The historical low for its price is recorded at $0.27, while the existing all-time high stands at $0.65. And as always, is it worth bagging? While still in the initial phases, Pyth promises to be a fundamental primitive powering the next generation of decentralized finance. Its design tries to balance the idealisms of blockchains with the realities of adversarial environments. Oracles are easy to underestimate, but they enable so many more complex financial applications. Pyth is positioning itself to be the gold standard for decentralized financial data, an essential cog to drive mainstream DeFi adoption. So if you ask me, definitely an uprod. Seventh token we have for the week is 1inch. 1inch is a decentralized exchange aggregator that allows users to find the best prices for cryptocurrency trades across multiple DEXs. It sources liquidity from various exchanges and splits a single trade across multiple exchanges to offer the best rates. 1inch offers flexible swaps and trades through its native protocol, which scrapes a handful of decentralized exchanges for the cheapest prices and reroutes customers' trades between them to try and ensure they get the best prices. So the cons I have observed with 1inch are: 1, the platform does not support the use of fiat currencies. 2, even though the platform is quite user-friendly, beginners could struggle to get a grasp on how to use 1inch. And 3, the infinity unlock feature could potentially be a point of attack in the future. While it does save on transaction fees and time, unlocking each transaction separately is much more secure. Crunching down the numbers, currently its market capitalization stands at $375 million, placing it within the mid-cap tier and indicating potential for further growth. Notably, this token does not have a capped supply, signifying an unlimited issuance. It's important to monitor the implications of this on inflation though. With a current holder count of 97,143, it has already achieved significant adoption. Additionally, the distribution among top wallet holders appears to be fair. And the important question here is it worth bagging? Liquidity remains the biggest problem that decentralized exchanges face when it comes to being competitive in the DeFi space. The 1inch platform has done a fantastic job so far in terms of solving this problem. That being said, the platform is likely better suited to traders who have some background in the DEX market. But if you ask me, I think this is worth bagging. Abroad. 8th token we have for the week is Derp. Derp is a recently introduced token serving as the native token for derpdex.com on ZK Sync base and OpBNB as outlined in their white paper. Derp functions as a utility token within the Derp DEX network and ecosystem, facilitating tasks such as covering gas fees and participating in XDerp staking with associated benefits in the Derp ecosystem. Upon reviewing their website, it doesn't look too polished and it has an unprofessional UI design. Notably, the roadmap is unavailable and the team responsible for the project has not been publicly disclosed. So crunching down on numbers, currently carries a market capitalization of only 1.2 million, indicating a higher level of risk associated with this investment. The maximum supply is a substantial 100 trillion Derp, and within the EDH ecosystem, there are only 150 holders. Examining the supply distribution among the top wallet holders reveals that the leading holder possesses 47% of the total supply, highlighting a noteworthy attention. But as always, is it even worth bagging? Derp is a newcomer in the market and overall it appears to be a risky project as it currently lacks any discernible utility. So, if you ask me, I think this is ridiculous. Thank you so much for joining us in Coin Rodar's first ever Mega Jumbo Special. If you have any tokens you'd like us to look into for next week, just comment down below and be sure to like, share, and subscribe to our channel, Web3 TV. And to all the upcoming altcoins out there, watch out because for sure you'll be under the Coin Rodar. This is Chef Rod. Always be sure to do your own research and see you guys again next Tuesday. Peace.